Welcome to today's Explainer. We're going to be taking a highly analytical, really professional look at the latest risk management data, and more importantly, the resulting premium impacts that are directly hitting Ontario vehicle owners right now. Look, if you follow the insurance market, you know the landscape is shifting incredibly fast. So we're going to break down the specific actuarial responses to these shifts, looking at some hard data to understand exactly where the industry is heading. All right, let's dive right in.
But before we look at specific policies, we absolutely have to address the macro trend driving this entire thing. Auto theft isn't just some nuisance anymore. It's a massive, highly organized crisis across Canada. We're talking about staggering estimated losses reaching up to $900 million. Just let that number sink in for a second. $900 million. That's not a localized issue of a few isolated break-ins. A loss of that magnitude represents a systemic hemorrhage in the auto insurance ecosystem. And when losses get that huge, well, the industry really has no choice but to adjust its risk models.
And that massive financial hit is exactly what's driving the industry's response right now. We can see this laid out perfectly in this official CAA Insurance product bulletin. It was issued on May 19, 2026, specifically Bulletin Auto on 3/2026, and it acts as a primary blueprint for how a major player in the Ontario market is strategically trying to mitigate this $900 million exposure. We're going to parse this document pretty carefully today because it reveals exactly how risk is currently being calculated, categorized, and ultimately priced.
So here is our roadmap for today. We've got 5 key areas. First, the $900 million theft crisis. Second, analyzing the surcharge policy. Third, trending targets and new additions. Fourth, persistent high-risk vehicle trends. And finally, geographic exclusions and rules. Okay, part 1. The $900 million theft crisis. Let's look at the impact and the proposed solutions. The bulletin actually makes a really interesting, clear point right off the bat. It notes that despite all the recent improvements in vehicle security tech and various public awareness campaigns, the impact of theft is still incredibly significant. The corporate perspective here is basically saying, hey, the industry alone cannot solve this. The document stresses that long-term theft reduction is absolutely going to require continued vigilance, heavily updated federal vehicle standards, and sustained public engagement. This is a massive takeaway for us. Insurers are essentially signaling that until federal standards actually catch up to how sophisticated modern theft rings have become, financial surcharges are going to be their necessary short-term defense mechanism. Moving on to part 2, analyzing the surcharge policy. Here's how that defense mechanism actually works.
So the core mechanism being deployed here is the high theft risk surcharge. And what's truly fascinating is just how precise its application is. This is not a blanket rate hike for everyone. It specifically targets vehicles that are model year 2022 or newer. The effective date is also pretty aggressive, coming up on July 1, 2026. And this applies right across the board, impacting both new business and renewals simultaneously on that exact date. Bottom line, if you own one of the specific target vehicles manufactured in 2022 or later, this surcharge is heading your way.
All right, part 3, trending targets. Let's take a look at exactly which new vehicles are being added to the list.
Looking at the newly added vehicles, a very clear pattern starts to emerge. We're seeing an undeniable concentration on premium Japanese brands. Specifically, the newly impacted vehicles are the Acura TLX, the Lexus GX550, the Lexus TX 500h, and the Toyota Land Cruiser. From a strict risk analysis standpoint, this tells us that highly organized theft syndicates are expanding their operational focus directly toward these newer, high-demand luxury SUVs. If you happen to manage a fleet or advise clients on vehicle purchases, this new list is a really critical indicator of where black market demand is shifting.
Which brings us to part 4, persistent high-risk vehicle trends. Let's look at what's staying on the radar.
The updated bulletin also outlines the remaining impacted vehicles, and this highlights a continued severe vulnerability for specific luxury SUVs and trucks that have seemingly been in the crosshairs of theft rings for years now. They are not dropping off the radar anytime soon. The risk remains extremely elevated. It's a brilliant illustration of just how ongoing and systemic this problem really is. When you group these remaining vehicles by manufacturer, you can clearly see the absolute dominance of a few key brands. Look at Lexus, for example. You've got the RX 500h, the TX 350, RX 350, RX 450, and the GX 460, all of them holding on to their high-risk status. Toyota is right there with them, retaining the Sequoia, Tundra, Highlander, including the Grand Highlander, and the 4Runner. We also see Land Rover's Defender and Range Rover models on there, right alongside the Jeep Wrangler. The crucial point here is that this isn't random. It signals that the export and resale markets for these specific, high-value assets are incredibly robust. Insurers are pricing that persistent structural risk directly into your premium. Now, beyond the specific makes and models, the bulletin establishes a completely fascinating value-based actuarial rule. Any vehicle with a manufacturer's suggested retail price of $125,000 or greater automatically gets hit with the surcharge. This is regardless of the make or model. But here is the really critical exception. Electric vehicles are entirely excluded from this MSRP rule. So think about that. You could have a $130,000 gas-powered sports car and get slapped with a surcharge, while a $130,000 EV avoids it entirely. It seems like highly organized theft rings just aren't quite ready to deal with range anxiety or EV charging infrastructure yet.
Amidst all of these additions and persistent risks, there actually is a brief silver lining for one specific segment of truck owners. The Dodge Ram 1500 is the singular vehicle officially marked as removed from the impacted list in this update. Now, whether this is due to improved internal security measures by the manufacturer or just a shift in black market preferences, we don't know for sure. But the actuarial data has clearly recognized a significant enough drop in theft frequency to actually remove the surcharge for this specific model. So, a bit of good news there.
Finally, Part 5. Geographic exclusions and rules. Because it's not just about the car, it's about where it's parked.
The bulletin highlights some very precise geographical risk shifts that brokerages and policyholders really need to navigate. For instance, the North Bay to Thunder Bay District, known as RT10, has been reinstated. That means it is no longer excluded, so vehicles in this territory will now face the surcharge. But in stark contrast, Northwestern Ontario, or RT11, remains excluded, with no change at all. This just demonstrates how incredibly granular the data is getting. The risk is creeping into certain northern districts like RT10, while RT11 currently maintains a risk profile that's just low enough to avoid the financial penalty. So location matters, literally just as much as the emblem on your hood.
Of course, applying all of these rules in practice definitely requires some nuance. The bulletin explicitly directs all stakeholders, whether you're an analyst, a broker, or just a policyholder trying to figure out your exact exposure, to consult the Ontario Automobile Manual for further eligibility criteria and any required documentation. The rules are strict, for sure, but the manual is the ultimate arbiter for how these premium updates are officially codified and applied on the ground.
So, what should we really take away from all this? With these significant, highly targeted premium changes locking in on July 1, 2026, the insurance industry is drawing a hard line in the sand against a $900 million problem. But let's be real, this is a dynamic chess match. As organized auto theft strategies inevitably adapt to these new financial and security hurdles, we have to ask ourselves, which vehicle categories, new technologies, or geographic regions will be targeted or excluded next? Thanks for joining me for this explainer. Keep analyzing the data and stay vigilant out there.